Hi everyone, I'm Maggie McGrath, Senior Editor at Forbes. We know from surveys that nearly 2 in 5 Gen Z members and millennials say that they have a harder time building wealth than their parents did. And so I'm sitting down with my colleague, Jeff Coughlin. He is a senior editor covering fintechs, and we are going to be talking about one of those fintech companies that is helping people build wealth. Literally has wealth in the name. Jeff, thanks so much for joining us.
Thanks for having me. Great to be here.
So you wrote a story on Wealthfront, which is a fintech startup that we actually covered back in 2014 in a story called The New Money Masters. But 10 years later, this company is finally profitable. We'll get into how they built profitability, but I want to start by asking a very broad question for those who might not know. What is Wealthfront and why do we care about it?
Yeah, so Wealthfront is what they call a robo-advisor. It's basically, they will create kind of customized investment portfolios for you based on your risk tolerance, your time horizon, are you saving for retirement? And so, yeah, it's a robo-advisor. And they started a little bit differently. They actually started by allowing people to pick money managers, professional money managers, and they kind of had a competition, which money managers are performing the best, and you could pay to pick a money manager, but they pivoted pretty quickly, just a couple years after they got that one going, into the robo-advisor. And so just like Betterment or Vanguard, other companies that have robo-advisors, that's what Wealthfront does.
Now, they only just reached profitability, and as I started this conversation saying, we've been watching them since 2014. What took so long to become profitable?
Yeah, it is a long time. I mean, I feel like you often see that with startups, but I think that for Wealthfront, they had fixed costs that were at a certain level, probably around $100 million or so. So they have this business model where they have fixed costs, which is mostly really employee salaries. They have about 280 employees, and a lot of those are engineers, which command pretty high salaries. And so, but they had these fixed costs that for a long time, I think they knew we have to get to really well above 100 million in revenue to actually become profitable. And finally, in 2023, after 14 years, their revenue really took off. It more than doubled to $200 million from about 80 million in 2022. And so finally, they've been able to get above, they had this level of fixed costs. Finally, they were able to kind of break through that threshold and become profitable.
What drove that breakthrough? Was it a rush of consumers using the service, or was it something else?
Yeah, a big thing was what they call cash accounts. It's basically high yield savings accounts. They're brokerage accounts that act like high yield savings accounts. And they've always offered a pretty competitive interest rate on these. They started offering them in 2019, and they were one of the early fintechs to start offering these high yield savings accounts. And they started very aggressive on the interest rates. They were higher than any other high yield savings that banks offered, even in 2019 when interest rates were super low. And they kind of stayed on that strategy. And now that didn't work so well in 2020 and 2021, especially when interest rates were zero.
They surged when did interest rates surge?
2022, early 2022, they started going up.
Okay.
And so that was the big thing, is they stayed on this strategy, and then they rose in 2022 and then in 2023. And because of that, they attracted, their assets in these cash accounts grew from, I think, about 9 billion at the end of 2022 to 27 billion at the end of 2023. So they added like $18 billion in new deposits, and they make money on interest through those. This is a very profitable product for them, more profitable than the average robo-advisor customer who's just buying the stock and bond portfolios. And so because they had this big surge in assets and on a profitable product, that helped them become profitable.
That's really interesting, because I'm thinking to what I was doing in 2021 and 2022, and I remember I bonds were really going up. So I was putting money in I bonds. I wasn't even considering a high yield account through something like Wealthfront. I mean, I do that now, but what I'm hearing is it sounds like during that time, as the economy is ebbing and flowing, they're just drawing. How many consumers came to them or customers came to them during this time?
Yeah, I think it was hundreds of thousands. I think that I don't know exactly, but I think it was in the hundreds of thousands, and so it was a lot of new customers, and it was a lot of, I think, probably interest from existing customers too, who said, "Wow, they're offering what is now a 5% interest rate. I'm gonna try this out and earn more interest than my bank, which is offering a lot less."
Does this indicate that consumers are more interested in high yield accounts than actively managed or robo accounts, or is it just a symptom of the economy at the time?
Yeah, I think it's a symptom of the economy at the time. I mean, they say that, when interest rates are high, they lead with cash accounts because it's a great marketing tactic. When interest rates are low, and inevitably they will go down. We don't know when, but eventually they will. And when they start to go down or they're low, they lead with investment accounts. And so they try to kind of toggle their marketing that way to the kind of economic environment.
Now, another factor that was going on here for Wealthfront, in 2022, UBS said it was going to acquire the business for $1.4 billion. That deal fell through. And what was the effect on Wealthfront's business from that deal falling through?
Yeah, I think one big impact was just on morale. One of their board members, Mike Volpe, talked to us about how they were demoralized, and I think it's really hard. Everyone is accepting this big payout is $1.4 billion. If you're an employee and you're thinking about buying a house, this is a fantastic windfall you're going to get, especially if you're an early employee. And it fell through. And you spend a lot of time, management spends a lot of time on these kinds of things, on, selling the company. And so when that fell through, it was demoralizing for people, for sure. The kind of fortunate thing is, at the same time that it fell through, they were just about hitting profitability. And so that was really helpful for them. This was late 2022. Interest rates were going up still. The cash accounts were really driving a lot of people to the business. And so that was fortunate for the timing where they were hitting profitability. And so, but instead of, the CEO, David Fortunato, instead of kind of being bummed out about it, and I'm sure he was, but instead of focusing on that, he focused on the cash accounts and kind of really trying to push those more. And luckily, their 2023 was a really good year for them.
He had an interesting comment to you, something to the effect of, you have to have a short memory.
Yes, yeah, I know. He's a pretty quiet and reserved guy, I would say, and I kept trying to kind of get him to talk about, how did it feel? What were kind of the emotions you had after this? And it was pretty limited what he wanted to say, except for that. You have to have a short memory for these kinds of things.
So he's focusing on the cash accounts, and that's interesting because I wanted to ask you, you wrote about how Wealthfront hasn't raised its rock bottom fees since inception, but has found a way to build a sustainable business. So how has it done that? Is it the focusing on the cash accounts, or is there another factor they're employing?
Yeah, it is a lot of things. The cash accounts definitely was a big driver, the biggest one over the past year or two. The other thing they've done is really just in general, they've kept costs reasonable. They've really had this culture of automating everything. Their founder, Andy Ratcliffe, said to us, if we couldn't automate something, we wouldn't do it. And so they automated the investment portfolios. They automated this process called tax loss harvesting, which is when you're selling losing investments in a similar time frame to offset gains from profitable investments. And they kind of automated this whole system so you could get a tax benefit from it. And so they did things like that. They don't have that many employees. They have 280 employees, which it's a decent size, but for a fintech that's been around for 14 years is not that big. And during COVID, when a lot of people were really hiring like crazy, they didn't add that many employees. They added maybe a few dozen. Half of their employees are engineers. So that's another way to automate things, focus on automation. They've kept a pretty frugal culture too. Like David Fortunato, in the early days, they bought the desks they got were from IKEA, and he said he personally built 40 IKEA desks for new hires, and they were like $130 each, so they were very cheap.
Keep overhead low when it comes to the office.
Yeah, exactly. And so, yeah, they don't spend that much on marketing. I think they spent $6 million in marketing in 2023, which is less than their competitors and not a huge amount. So I do think they have this culture of keeping costs reasonable.
So they keep the business costs low so they can keep the fees low. What are their fees right now?
They're 25 basis points, so 0.25% of assets.
And how does that compare to their competitors like a Betterment or others on the market?
Yeah, so Betterment, it is the same for their kind of lower tier service. Betterment has other services too, where they offer like they call it a hybrid offering, essentially, where you get access to a financial advisor as well. You can do phone calls with them. That one I think is 65 basis points. Vanguard, I believe, is about 20 to 30 basis points. So they're kind of in line with Vanguard. I think one of Vanguard's features is a little bit lower on price, but they're kind of in line with some of those others.
So speaking of Vanguard, you also write that the big winner in terms of assets has not been a fintech startup. It's Vanguard, and across some of its platforms, not even all of it, is $300 billion in assets under management.
Yeah.
So what's the long-term outlook for a fintech startup like Wealthfront when you have the incumbents like Vanguard commanding so much money?
Yeah, it's a great question. I think there is certainly a place for Wealthfront, as they've proven. They've built a pretty good sized business. They have about 800,000 customers. They have, $200 million in revenue in 2023, $65 billion roughly in assets. And so I think it's really hard to say, are they going to be able to get to, I don't know, are they going to be able to get to 25% market share? Or that's hard to say because Vanguard is so big and powerful, has so much kind of built-in distribution. And a lot of Vanguard customers, a lot of Vanguard's robo-customers, most of them were already Vanguard customers. So they were already into Vanguard mutual funds. So that's very powerful for them to be able to sell things to existing customers. So, but I think there is a good, and they've proven it for Wealthfront. I think there's a good place for them in the market where, are they going to be $100 billion company? I don't think so, but they've proven they can get to over $1 billion. If they keep growing the way they do, I think they could be in the multiple billions. So I think there's a place for them. It's a little bit of a smaller niche. Like I said, 800,000 customers. It's not, mass market, tens of millions of customers.
And the average income for their customers is relatively high, about $120,000 a year.
Yes, that's a good point. Yeah. So
that's much higher than the median income in the United States.
Absolutely. You're right. So that's a great illustration of how it's a niche. But they play, if they can keep kind of penetrating this niche, and maybe broadening out a little bit, I think there's a good place for them.
Will they ever be a publicly traded company?
So they want to be. Their investor, one board member, Mike Volpe, says that's the goal, that's the hope. Wealthfront CEO says, we're not focused on it now, but it's certainly possible. And so I think that that's their goal. They're a little small now, I think, to go public, and Mike Volpe conceded that too. There's some research recently saying that if you're below $700 million in revenue, the IPO returns have not been good, and so they're about $200 million. Mike Volpe thinks they can maybe double this year, so maybe it takes a couple more years if things still go well to get to around that level. That's assuming a lot, but I think I could see it. I think it's 50-50 on whether they do it or they get acquired or they keep going as private, but I could see it. could see it happening.
So you cover fintech companies as your beat. What's the one or two things you're going to be looking for from Wealthfront over the next year or two?
Yeah, I think that it'll be really interesting to see. I mean, the growth in 2023 was so high. Can they double again? And I think it's possible. They said their Q1 revenue grew 80% in 2024 versus Q1 2023. I think it's possible they double again, but that will be the thing I look for the most is what is growth this year, and then also what happens with the cash accounts as interest rates, as they eventually start to go down. Again, we don't know when, but what happens there? Do some people pull their money out of cash accounts? And how much, let's say, assuming interest rates go down and the stock market potentially goes up, how much more can they offset that? I don't think that they're going to be as profitable if they start losing cash account customers and gaining more investment account customers. We know the cash accounts are more profitable, and so that's a potential factor. But yeah, mainly I'll be watching for the effect of lowering interest rates and then the growth. What does the growth end up being?
And what's the number one takeaway for consumers here? If folks watching this don't know where to put their money, have their money with an incumbent, have their money with another fintech startup, what's your message for them?
Yeah, it's a good question. I think that I personally think robo-advisors are a good offering. I think that for someone who wants to be proactive in managing their finances, but they're not going to pick stocks, they're not going to even choose exactly which mutual funds they want or what allocation they want across mutual funds, I think robo-advisors are a good option. I personally use one. And I think, Morningstar has good research on who are like the benefits, the pros and cons of all the different robo-advisors. So I would say do research in places like Morningstar, objective places on what are the benefits. I don't think I would recommend one in particular, but I do think robo-advisor, and you think about the top, there's a few that are really at the top. There's Vanguard, Wealthfront, Betterment, Schwab and Fidelity have an offering too, although I don't know if they're quite as highly rated as those others.
Jeff Coughlin, thank you so much for coming in and breaking this down for us.
Thank you, Maggie. Enjoyed it.